Hello again, accountants. We are looking at Unit 10, Section 3 this time, the assignment, financial statement, and liquidation of a partnership. Surely you have read the text by now and understand that the liquidation of a partnership means that you are closing down the business. So after liquidation, the business will no longer exist. So we've mentioned in this class how our different assets have a different value of liquidity, or how liquid something is, and we said that money is the most liquid form because that's what we're talking about, is how easily it is transferable to money. So basically what we're doing is we're shutting down our business, so we're kind of selling off everything to get money that we can and paying off everything. And so that's where that term comes from, liquidation of the partnership. Now, don't confuse this with the dissolution of a partnership. You should have also read about that in your text. And with a dissolution, that just means that you're kind of structuring the partnership. Maybe one partner is getting out, but another one's coming in, or you're adjusting your percentages maybe on ownership. So don't confuse the two of liquidation means closing it down, and dissolution means you're just reconstructing the partnership. Okay, so in this assignment, in part 1, we are looking, this is a lot like, I believe we talked a little bit about this in section 2's assignment. So we are looking at, we're selling off our assets and paying off our payables, and then kind of splitting the profits and losses depending on how much has been invested by each partner. So in this situation, we have Hooks and Franklin. They're in the process of liquidating their partnership. They share profits and losses in a ratio of 3-to-1. So if you remember from the last assignment, to figure your fractions here, you would add these numbers together, and then to get your denominator, and then each of these acts as a numerator for that fraction. So they have sold all the non-cash assets of the partnership. The transactions for the sales are as follows. So then they list for you what was sold. We sold the rest of our equipment for $12,000. So that would be a gain that says our book value was $10,000, and we sold it for $12,000. So that's good for us, or Hooks and Franklin. And then on May 17th, accounts receivable was worth $7,000, and we sold that to a finance broker for $6,800. So a finance broker, basically, we sold them those accounts, so those customers still owe their money, but basically this finance broker bought the accounts from us. So now he can collect that money, and we don't have to worry about it anymore since we are closing our business. And then on May 20th, our merchandise inventory, which cost us $3,000, was sold for $1,900. So we have a loss there. So what we need to do then is we need to figure out how much each partner, how much their share is in each of these loss or gain, and then we're going to journalize those transactions. Okay? So to determine so May 15th, we had the equipment that we sold for a value of, it was valued at $10,000, but we sold it for $12,000. So the gain or loss on the sale, we would take what we sold it for minus what the value was. And so in this instance, since we sold it for more, we have a gain of $2,000. And then we need to calculate Hook's share in this gain or loss. So up here we see that they have a profit ratio of 3-to-1. So since Hooks is named first and Franklin's named second, we're going to assume that this 3 goes with Hooks and this 1 goes with Franklin. So that gives us our fraction. We have 3/4 going to Hooks. So I need to take 3/4 times the 2,000, find out his share. And then that leaves us with 1/4 going to Franklin. So we need to do the math and figure out these numbers, and we come to find that Hook's share of this gain is $1,500 and Franklin's share is $500. Okay, and so then we need to journalize this transaction. So you might just think that, okay, I have to deal with Hook's and Franklin's capital accounts, obviously, but then also don't forget that we sold off our equipment, so it's going to affect that account as well, and we got $12,000 for it. So when we go to journalize that entry, we need to think about which are the accounts that we're using and how they're increasing or decreasing. So the account that will be debited would be my asset account of cash. We'll call it cash in bank. And this is going to be for the amount that we sold it for. So we sold it for $12,000. That's how much cash they gave to us for this office equipment. Okay, so then we determined that we had a gain of $2,000 and split it between Hook's and Franklin's in accordance with their shares. So now we have to record those amounts. Since those are gains, they're going to increase their owner's capital accounts. I'm trying to kind of speak slowly so that maybe you can catch it before I say it. So Hook's owner's capital is going to increase by $1,500, and then we have Franklin capital, which will also increase by $500. And then we have one more thing to record. We sold off our equipment that was valued at $10,000, so we have to make that entry down here as well. So since equipment, that should ring a bell as an asset account, and if we want to decrease, because we sold off the equipment, so we're decreasing it by $10,000, we're going to credit that asset account by $10,000 because that was the value of it. I don't get confused and credit it for $12,000. That's just what we got paid. We want to record the value. So just real quick, I just like to double check to make sure my debit of $12,000 equals my credits of $10,000 plus here's $2,000, so $12,000, and yes, I'm good to go. My debits equal my credits, so I can move on to the next one. So in the next one, you'll do the same type of thing, only in this instance, we had accounts receivable worth $7,000 and we sold it for $6,800. So that should tell you that we incurred a loss of $200. So we have a loss of $200, and then you'll need to figure out of that $200 how much of that is Hook's share and how much of that is Franklin's share. And then you'll record that transaction as well. So same type of thing. We got $6,800, but in this time with our capital accounts, they're losing money, so those will also be recorded as debits. And then we're closing that accounts receivable account for $7,000 because that's what it was worth. Okay, so those would be your journal entries for May 17th. And then on May 20th, we sold off merchandise inventory, and you can see that it was worth $3,000. We sold it for $1,900. So again, that is another loss that we'll have to record. Okay, and that's very typical when you're selling off items from your business. If you're closing down, a lot of times you've probably seen sales or like businesses that are going out and have these extreme clearance sales. So some of them end up actually losing money on some of those sales. So that's just kind of your typical business. And then again, just total up your debits and credits just to make sure everything equals out. Okay, and that is part 1. Then looking at part 2, we have another business that has planned to liquidate. Our task is to help them liquidate the partnership. Below they give us the remaining assets and liabilities. Rex and Jack share all profits and losses equally, so that makes it a little easier. Here we have cash. We have a cash and bank balance of $20,000. Accounts receivable $12,000. Merchandise inventory, equipment, accounts payable. So we still owe $15,500. And then it gives us the balance of each partner's capital account. So what we do then is we have to record these transactions. So, for instance, in this first one, customers will have to pay their accounts in full before the liquidation date. The full amount is received. So it's saying that this $12,000 that we were owed by customers, we were able to collect all of that. So thank goodness, because that doesn't usually happen. So we'll need to record that journal entry showing that we recorded this amount for accounts receivable, and then showing that accounts receivable is reducing and closing out for that amount. So that'll be your first recording. Then merchandise inventory was sold for $40,000, resulting in a loss of $2,000 to the partnership. Okay, so that's going to be like in part one. We sold it for $40,000. It was worth $42,000. So we have a loss of $2,000 that needs to be split evenly this time by each of the owners. So if you need to, refer back up to what you put for this transaction and look to how you record. This was for merchandise inventory. So we'll be increasing cash, decreasing capital accounts, and decreasing merchandise inventory. And then we have equipment was sold to a local retailer for $70,000, resulting in a gain of $10,000. So that's good. Here's our equipment value at $60,000. We sold it for $70,000, so that's a gain. That again we'll have to split between our two capital accounts, and then closing out our equipment account. So then our last transaction is that we paid off our accounts payable in full. So we paid off our accounts payable with this $15,500 and closed out that account. So now we have to, you should be journalizing each of these transactions as you go. Then something that's going to be different is I have these T accounts down here that you will need to fill out also as you go. So just to help you get started with these, our capital accounts had a beginning balance of $59,250 each. And then our cash in bank had a balance of $20,000 when we started. So then as you go through these transactions, you'll have to also record how this is affecting each of those accounts. So with this first one, customers paid off their accounts in full, their accounts receivable. So that was $12,000 worth of cash that we should be increasing. And then on the next one, we sold merchandise inventory for $40,000, which had that loss of $2,000 in the partnership. So that will also affect, we sold it for $40,000, but then we had that loss that we had to divide between each of our partners for $1,000. So this is what you need to be doing with every transaction. Equipment was sold for $70,000 with a gain of $10,000. So we sold equipment for $70,000 and a gain, so that would add $5,000 to each of our capital accounts. So now you need to, and there's one more I think, we have paid our accounts payable in full. So that $15,500 we paid off, but that deducts from our cash and bank. So now you need to find the balances of each of these accounts and make that final recording. So it should look like this. We're going to close out these accounts. So we have Rex Capital, Jack's Capital, and then cash. So there's a clue on how to set up that last journal entry.